Hi there. A lot of talk lately about silver getting shaken out, gold losing momentum, government debt getting impossible to manage, and digital money turning into something way bigger than a payment upgrade. So, in this video, we're going to separate fear from fact, and you are going to walk away with a clearer picture of what is actually happening, what is exaggerated, and what investors should be thinking about before the next big move. Today is Saturday, May 2nd, New York time. Comment below what day and date you're watching from, because this story is moving fast, and your timing matters. And if you value my content, support the channel by subscribing and commenting John A.G. Best below. That tells me you're here for serious market breakdowns and not just recycled market noise. So here's the story in plain English. Silver ran hot, pulled back hard, and then started frustrating everyone. Gold hit record territory, corrected, and made people question whether the move was over. At the same time, governments are still borrowing huge amounts of money. Central banks are still buying gold, and the digital currency conversation is getting louder. On the surface, that sounds like one giant conspiracy chart with every arrow pointing to the same scary conclusion. But if we slow down, it gets more useful. Silver is the first piece. Based on recent industry numbers, the silver market is expected to remain in deficit again this year, even though some industrial demand is cooling because high prices are forcing manufacturers to thrift, substitute, and use less silver where they can. That is important because it tells us the story is not one-sided. Demand is not exploding in every category. Jewelry is soft, silverware is weak, solar is still important, but that sector is trying to reduce how much silver it uses per unit. So if somebody tells you silver can only go straight up because industry needs it, that's too simple. However, the other side is just as important. Physical investment demand is expected to improve, supply growth is not huge, recycling is rising because high prices are pulling metal out of drawers and vaults, and the market still needs above-ground inventories to fill the gap. That's not a dead market, that's a tight market trying to breathe. And that explains the pain. In a tight market, price can still fall if traders are over-leveraged. It can still drop if speculative money exits. It can still punish late buyers. Tight supply does not mean smooth price action. It means the floor can be stronger than people think, but the ride can still be ugly. Gold is the second piece. Recently published numbers show gold demand by value hit a record in the first quarter, with bar and coin buying extremely strong, ETFs still adding metal, and central banks buying roughly a couple hundred tons on a net basis, even after prices had already reached historic levels. That matters because central banks are not usually emotional buyers. They are slow, institutional, political buyers. They don't buy because a chart looks exciting on social media. They buy because reserves, sanctions risk, currency trust, and balance sheet protection matter. But here's the catch. Central bank buying does not make gold immune to correction. Gold can be structurally strong and still drop sharply. If investors are too crowded, if the dollar bounces, if real yields move, or if people take profits after a huge run, gold can pull back and still remain in a longer-term bull market. That is why I don't like the simple phrase, gold is safe. Gold is not safe from volatility. Gold is safer from counterparty risk than many paper assets. Those are different things. Now let's connect that to debt. According to recent budget tracking, the United States is already spending hundreds of billions just on interest this fiscal year, and interest payments are running higher than last year. The bigger issue is not just the number. The bigger issue is the direction. Old low-rate debt matures, new debt gets issued at higher rates, and the government keeps borrowing to cover the gap. That's how debt starts feeling less like a tool and more like a treadmill. And no, that does not mean default tomorrow. The United States still has enormous capacity, deep markets, and the world's reserve currency. Anyone pretending collapse is guaranteed next week is selling emotion. But the long-term math is getting more uncomfortable. When interest becomes one of the largest spending categories, every political choice gets harder. Do you tax more, borrow more, inflate more, cut spending, pressure banks and institutions to hold more government debt, keep rates lower than inflation for years? None of those choices are painless, and this is where digital money enters the conversation. The Federal Reserve says it has not decided to issue a retail central bank digital currency, and its own public information says it would need an authorizing law before moving forward. That is a major detail. In America, this is not officially something that can just appear overnight with no political process. Europe is further along, but even there, the current public timeline points toward a pilot later, with possible first issuance still years away if legislation moves forward. Also, the European design discussion includes holding limits and a reverse waterfall feature, which means the system is not being presented as unlimited digital cash sitting outside the banking system. So if someone says CBDC is already here and tomorrow all money is trapped, slow down. But if someone says there's nothing to worry about at all, slow down there too. Because the real issue is not only launch date, the issue is design. Once money is programmable, rule changes become easier. Once every payment leaves a centralized trail, privacy becomes a permissioned feature. Once wallets have limits, those limits can become policy tools. At first, the use cases always sound reasonable. Stop fraud, stop terror financing, stop tax evasion, make payments faster, help people without bank access, provide offline emergency payments. A lot of that sounds good. The concern is what happens after the rails are normal. Can spending be nudged? Can balances be capped? Can stimulus expire? Can certain purchases be blocked? Can emergency taxes be applied instantly? Can your ability to move money be tied to your identity, your location, or your compliance score? Those are not crazy questions. They are design questions, and history shows that crisis rules often become normal rules. After security shocks, travel changed. After banking crises, compliance rules changed. After health emergencies, movement and business rules changed. Whether you agreed with those policies or not, the pattern is obvious. During fear, people accept controls they would have rejected during calm. That is why the debate has to happen before the system becomes invisible. Now here's the twist many people miss. The United States may not need a classic retail CBDC to move toward a digital dollar world. Stablecoins already operate on programmable cross-border rails, and recent official research describes them as a market in the mid-hundreds of billions with annual settlement volumes in the trillions. Recent U.S. policy has also moved toward regulating payment stablecoins and treating permitted issuers more like financial institutions for anti-money laundering and sanctions purposes. So the future may not look like one government coin. It may look like regulated private digital dollars, bank tokens, payment apps, stablecoins, and government compliance rules all sitting on top of each other. That is less dramatic than the usual CBDC nightmare, but it still raises the same question. Who controls the exits? If your money moves instantly, it can be frozen instantly. If wallets are convenient, they can also become gates. If every transaction is data, then privacy stops being automatic and becomes something regulators decide how much of you deserve. This is why gold and silver keep coming back into the conversation. Physical metal is not perfect. It has storage risk. It can be taxed. It can be hard to sell at a fair price during panic. Premiums can get ridiculous. And if you buy too much at the wrong time, you can still feel trapped. So don't turn metal into a fantasy. Metal is not a magic shield. It is a form of financial redundancy. That's the right word. Redundancy. You don't own insurance because you hope your house burns down. You own it because you understand bad things sometimes happen. You don't own cash because cash is exciting. You own it because liquidity matters. You don't own productive assets because they never fall. You own them because long-term income matters. And you don't own some metal because it pays you a dividend. You own it because it sits outside a lot of digital promises. That distinction matters. If you are new to precious metals, don't rush in because one video scared you. Think about your allocation. Think about your time horizon. Think about how much volatility you can actually tolerate. A person who says they are a long-term metals investor, but panics after one pullback is not a long-term investor. They are a short-term trader wearing a long-term costume. Start with your goal. Is this insurance? Is it a trade? Is it savings outside the banking system? Is it a hedge against currency debasement? Is it diversification from stocks and bonds? Each answer leads to a different plan, and a plan beats panic. If you decide metals belong in your life, build the position in stages. Buy a piece. Wait, watch how you react. If price rises, you own some. If price falls, you still have dry powder. That is not glamorous, but it keeps you from turning one emotional decision into a financial injury. If you're successful, share your success story in the comments so others can stay motivated. Now let's talk about people who bought near the highs, because I know some of you did. You saw silver screaming higher. You saw gold breaking records. You heard debt, inflation, digital wallets, and central banks all in the same sentence. And you thought, I need protection now. I get it, but your entry point is not your identity. Don't defend a bad process just because you already made the purchase. Go back and ask, would I still buy this amount today with the same information at this price inside my overall plan? If the answer is yes, then volatility is just the cost of admission. If the answer is no, then learn from it. Maybe you bought too much. Maybe you bought too fast. Maybe you mixed up fear with conviction. That lesson is expensive, but it is still valuable if you actually use it. The worst move is to learn nothing. Now, I also want to challenge one popular idea. Some people act like if digital money expands, gold and silver automatically explode overnight. Maybe, but maybe not. Governments can regulate metal. Dealers can widen spreads. Taxes can change. Reporting rules can tighten. Physical supply can become available at one price on a screen and a totally different price in real life. So the goal is not to dream about chaos. The goal is to avoid being dependent on one system. That means having more than one way to save, more than one way to pay, more than one kind of asset, and more than one plan for your family. And that brings us to the part almost nobody wants to talk about: education. If your children understand saving, inflation, interest, debt, rent, mortgages, leases, taxes, budgets, and ownership, they are already harder to manipulate. If they don't understand those words, they can lose financial freedom long before any digital wallet shows up. A confused person is easy to steer. A financially literate person asks better questions. So yes, talk about gold, talk about silver, talk about digital money, but also teach the basics at home. Explain why money loses purchasing power. Explain why debt can be useful and dangerous. Explain why a bank balance is a claim, not the same thing as cash in your hand. Explain why owning an asset is different from owing payments on something. That may be the most practical protection of all. One more thing, and this is important. A lot of people confuse preparation with prediction. Preparation says, I don't know the exact timing, so I want options. Prediction says, I know exactly what comes next. Markets punish that second mindset over and over again. The debt problem can stretch longer than you expect. Silver can stay sideways longer than your patience. Gold can correct while the long-term case stays alive. Digital rules can arrive slowly, under friendly names, before people understand the trade-off. So your job is not to win an argument online. Your job is to build a life that can handle uncertainty. That means less drama, more discipline, and a plan you can actually follow when the screen turns red. That is boring, but boring often wins when everyone else is reacting from emotion and pressure. So putting this all together, what do we actually have? We have silver in a volatile correction, but with a still tight supply backdrop. We have gold correcting from extreme highs, but with central banks and investors still treating it like serious financial insurance. We have government debt becoming harder to ignore, but not an immediate end-of-world signal. We have digital currency projects moving forward, but on timelines and legal structures that are more complicated than the panic version suggests. And we have stablecoins quietly building a digital dollar layer that may matter just as much as any official CBDC. That's the real story. Not panic, preparation, not all in, diversification, not blind trust in government, but also not blind trust in influencers, dealers, or anybody else who benefits when you act emotionally. Because the people who survive messy financial periods are usually not the loudest people. They are the people who think early, size positions properly, stay flexible, keep learning, and refuse to let fear make every decision for them. If you're holding metals, understand why. If you're buying more, do it with a plan. If you're worried about digital money, speak up while the rules are still being written. If you're worried about the next generation, teach them money before the system teaches them the hard way. That's where confidence comes from. Not from pretending the risks aren't real, and not from pretending every risk arrives tomorrow morning. Confidence comes from knowing what you own, why you own it, and what you will do if the story takes longer, gets uglier, or surprises everybody. As always, this is for education and discussion only. I'm sharing market context, public information, and my own interpretation of the risks. I'm not telling you what to buy, sell, or hold. Before making big financial decisions, talk with a qualified professional and make sure every move fits your own goals, time frame, cash needs, and risk tolerance.